Debt, Lesson 4, Home Loans. In this lesson, you're going to learn about the fees associated with taking out a home loan. You're also going to learn about down payments, interest rates, and how your credit score affects the interest rates that you qualify for, and how all of those factors are used to figure out what your monthly mortgage payment will be. You're also going to learn about foreclosures, which is what can happen if you fail to make your monthly mortgage payments. So what is a mortgage? A mortgage is a loan from a bank or other financial institution that allows an individual to purchase a property or a home. Mortgage payments will typically be spread out over a time period of 30 years. A house is probably the most expensive thing that you're ever going to buy in your lifetime. People often refer to a house as an asset because it has real value. However, it's only an asset if you rent it out or you sell it, because assets are things that make you money. Liabilities cost you money. While you're living in a house and paying the mortgage and all the additional expenses that go along with it, it's a liability. It just costs you money every single month. When you go to buy a house, you're probably going to have to save up money for a down payment. Now, there's no universal minimum down payment amount, but the more you pay up front, the lower your monthly mortgage payments are going to be. You could potentially qualify for lower interest rates, and you'll be less likely to have to pay mortgage insurance. However, 3 to 5% of the value of a house is considered the absolute minimum for a down payment, unless you're a veteran. There are special loans that veterans qualify for that don't require any money for a down payment. A down payment of 20% of the value of a home is what's recommended for avoiding paying mortgage insurance. So if you go to buy a house for $400,000, you'd need $80,000 just to meet that 20% qualification. And for most people, that's not realistic. Half of working Americans don't even have $400 in their savings account to cover an emergency, let alone $80,000 to use as a down payment for a house. The average person puts down 3 to 5%, and it takes them a while to save up just for that. So just know that a smaller down payment means a more expensive mortgage in the long term. Private mortgage insurance, also called PMI, is a type of mortgage insurance that protects the lender, not you, if you stop making payments on your loan. PMI is usually required when you use a conventional loan, which is a type of loan that's not part of a government program, and you make a down payment of less than 20% of the home's purchase price. So, as an example of PMI on a conventional home loan, we're using a PMI mortgage calculator from creditkarma.com. We used the 2022 national average home price of $428,000 with a 3.5% down payment of $15,000, because 20% down would be over $85,000, and that's just not realistic for most people. The estimated interest rate is 7.28%, which is what a person with a credit score of 640 currently qualifies for. Because the down payment was less than 20%, the estimated PMI for this house would be $705 per month. That's in addition to how much your mortgage payment would be. I'm going to say that again. That's over $700 a month. That's not going towards paying off your house. It's literally just a penalty that you have to pay because you bought a house without making a 20% down payment. PMI can help you qualify for a home loan that you might not have been able to get without it. Having PMI will increase your monthly payments because the PMI premium is added to your mortgage payment. So while it does make it so that you can buy a house, it's also going to cost you a lot more money every single month for your payment. Next, you need to know about mortgage interest rates. A mortgage rate is the amount of interest charged on a mortgage loan. Mortgage rates can be either fixed, which means that they stay the same for the entire term of the mortgage, or variable, which means that the interest rate can fluctuate and go up and down. The interest rate you're charged is typically based on your credit score. As you know, your credit score represents how likely you are, or not, to repay the money that you borrowed. The higher your credit score, the more likely you are to qualify for a lower interest rate. The lower your credit score is, the more likely you're going to have to pay a higher interest rate. If you don't have a high credit score, you won't qualify for the best mortgage rates available. However, you can still qualify to buy a house, but you'll end up paying more money over the length of the mortgage. It's going to cost you tens of thousands of dollars over the life of your home loan if you have a low credit score. This is a monthly payment breakdown using a mortgage calculator from bankrate.com. The first example shows you what your monthly payment would be if you had a credit score of around 640. We used the national average home price of $428,000, went with a 3.5% down payment, which is roughly $15,000, on a 30-year home loan. We added in the estimated PMI of $705 since the down payment is less than 20%. The monthly payment for a $428,000 house, including taxes and fees and your PMI, would be around $3,870. Here's another monthly payment breakdown that shows what your monthly payment would be if you had a credit score of 740 or above. The current rate for a score of 740 is 6.44%. A higher credit score also means a lower monthly PMI payment, so rather than paying $705 a month, it would be $258 per month. The payment for a $428,000 house, including taxes and fees, would be around $3,200 per month. That's a monthly difference of $678 for the exact same house. Mortgage amortization is a financial term that refers to the home loan payoff process. This is basically a payment schedule for paying off your debt over time. Part of the payment you make is going to go to the loan principal, and then the other part is going to go to the interest that you owe on the loan. Now, initially, the amount that you pay towards the principal, it's going to start out small. And then gradually, it's going to grow bigger and bigger month by month. In the beginning, most of your payments are going to go towards interest first. When you borrow money from a bank, they want to make sure that they collect their interest up front, which is why most of your payment goes to them, not towards paying off what you owe on the house. Each month, you pay a little bit less in interest, and a little bit more of your payment goes to the principal balance that you owe. And eventually, that amount evens out around the 15-year mark on a 30-year home loan. And after that, more of your payment goes towards the house than the interest. But here's the catch. Most people don't live in their house that long. They usually sell it before then, and knowing that you probably won't live there forever, the bank wants to collect as much interest as possible right away. The amount that you pay in interest can easily double the amount that you paid for the house in the first place. A foreclosure is what happens when someone fails to make their monthly payments on their mortgage. A foreclosure is a legal process that allows the lender to seize the property and sell it as a way of recovering the money that the borrower failed to repay. And this is a perfect example of a secured loan. If you stop making payments on your house, the bank can legally take it and sell it. Typically, someone has to miss multiple payments in order to trigger the pre-foreclosure process. The foreclosure process varies state by state. Each state has laws that govern foreclosures and the timeline in the process for selling that property. Some states allow lenders to foreclose in less than 6 months, and other states can take more than 5 years to foreclose on a property. Having your house foreclosed on, though, is right up there with bankruptcy on the list of bad financial situations that you don't ever want to find yourself in. There's a lot more to know about home loans than what was covered in this lesson. However, we decided to focus on the specific key areas highlighting the expenses that come from taking out a home loan. In this lesson, you learned how your credit score can affect the interest rate you qualify for on a loan. You learned about how interest rates affect your monthly payments, as well as how much you're going to pay overall for the house through amortization. You found out that most people can't afford to put 20% down on a house as a payment, and that mortgage insurance is a big amount of money that you're going to have to pay every month in addition to the mortgage if you put down less than 20%. You also learned that failing to make your monthly payments can result in a foreclosure. In the next lesson, you're going to learn about student loan debt and the struggles people have with paying those back.